Your GIP map shows quad 2 in Q3. What quad do you foresee for Q4? So the quad 2 is obviously coming from a lot of the sequential momentum we saw from May through July at least. It's looking like August may see some continued acceleration as well, but clearly we expect the economy to inflect into quad 3 at the bare minimum starting in September. And then lastly, we have that continuing through the Q4 of this year.
Yeah, the quarter, if you focus just on the quarter, this happened obviously as well in Q1.
Q1, same thing.
Because when we made the quad 4 and Q2 call, that started getting pulled forward in the last month of the first quarter. But if you go back on the page, like some people are doing, like not that you did this, but some people in a more snarky or silly way, really. They're like, well, it says right there, and it's like, no, you're not. You don't take the time. You don't work hard like us. You're not deliberately studying it and get to understand that. Hey, it might move intra-quarter, you know. And by the way, August was really the big month where the intra-quarter returns of the market were quad 3, and that's the most important thing. Is that I care about whether or not my position's making money, not whether or not I'm right on what it says on a quad map for the full quarter. That's just not the way to play the game. Again, I think most of you understand that. But again, I appreciate the question because it's important to call out. That's kind of like almost like a little bit of a gotcha question that some people ask, but it's really not gotcha at all. You know, particularly August to September, I fully expect quad 3 portfolios to perform. And if and when they don't, then I'll change because I like to perform.
Well, the market's clearly been pricing in quad 3 since the peak and high beta cycles in early June.
Yeah, it was in June.
Yeah, exactly. So the market is clearly seeing something that doesn't look like a quad 2, a durable quad 2 recovery on the horizon. Now, you know, the sort of reopening thing has obviously catalyzed some positive sequential momentum that has extended itself in some degrees into August. But the reality is, if you know you get to the other side of reopening, you lose that momentum. Obviously, we're having a pretty big fiscal drag in impulse terms here in the third quarter as well. You combine those two things, it's very likely the economy should inflect lower. Not the least of which is reasons you know the labor market remains very sort of imbalanced. You know, one chart we highlighted in our mid-quarter themes deck
sort
last
of.
week.
I mean, it looked explicitly imbalanced.
135, Eric, is that chart. It's the most imbalanced labor market we've ever seen. And this is data going all the way back to the late 1940s when the unit labor cost data started being published. You know, you look at the spread. So what we're showing in this chart is the peak to trough drawdown in GDP for GDP in the current period, the far right of the chart. We're using our Q4 2020 estimate of minus 4.9%, which is pretty much on par with the peak to trough drawdown we saw in the GFC. And the blue bars are showing kind of the what has occurred from the start of the recession to the culmination of the recession in unit labor costs. So typically what you see is a little bit of a rise in unit labor costs as output draws down, and you don't fire people fast enough, so you have this kind of widening divergence.
They maintain being paid pro-cyclical or late cycle peak wages.
Exactly. Wages tend to always peak in recession. That's pretty consistent. It's it's the most late cycle of indicators in the economy, and so we have this ridiculously wide level of unit labor cost inflation relative to the drawdown in output. So what that tells you, one of two things has to happen over the next quarter or two. One, we need to have a pretty material recovery in the output gap, or we need to have a pretty material drawdown in labor. If you want to take this from the labor side, you go ahead a couple slides to 138 or 3 slides to 138. We just show, you look at, the rate of change of permanent employment in the last cycle. If you look at it, just looking at the GFC, we saw permanent employment quadruple from its lows in the last cycle. We've only seen it double thus far.
You guys have that chart up?
Yeah, that's 138. Yeah, so
I don't know if they put it up on the screen.
I'll put it up on the screen, right?
Yeah. There it is.
Yeah, so we saw permanent unemployment quadruple in the last cycle on a similar size GDP drawdown as we have projected currently. But we've only seen a doubling of permanent unemployment to about 3.6, 3.7 million as of July. We're going to get this data on for August and at the end of this week. It's likely we're going to see another positive payrolls print. But the reality is, when you look forward, 3 to 6 months over this awkward period between broad immunization and broadly effective therapeutics, and now between now and then, you have this awkward economy where you either need to have output recover pretty materially, or you need to have labor come down pretty materially. So that's something we want to make sure that's on every investor's radar, certainly at these levels in 10-year and 30-year yields.
Yeah, just so you know, why would labor come down materially from the peak of the cycle? Don't forget, coming into this, we're the only firm that made this call. It was peak cycle, pre-COVID, and COVID was just going to exacerbate the slowdown, is that you go from peak cycle labor to people getting fired because their bosses can't afford to pay them peak cycle labor. This is going to be a great rap song.
There's no revenues.
It's like
how do you pay people?
Yeah, so then then unit labor costs come down. Unit labor costs just means what are you getting paid, right? So you're getting paid peak, and then PPP comes out. So people that were fortunate enough to maintain their job, they didn't. Well, I mean, some of them actually got paid less, but generally speaking, the wages stayed in place. Then PPP rolls off. Boom. People start to get fired again. So again, this is these are the days of our lives. We'll have to see how it plays out. But again, isn't it so wonderful that everybody else has figured out precisely how the V-shaped recovery has already happened? Anyway, thank you very much for your time.